Good afternoon. I hope everyone's doing well. This is Craig Modelmog with this week's episode of Wall Street X's and O's for the week ending June 18th. It's crazy. We're almost halfway through the year. And you know what? It's summertime. It's been hotter than hell here. And you know what? It feels good. Not going to lie. We went from being, especially in Colorado, we went from being Seattle in May, where we literally had more rain and cloud cover than Seattle had, to now I feel like we're in Phoenix or Vegas. It's good. I heard Death Valley today might set an all-time record for the hottest temperature ever. So hey, you know what? Welcome summer. That's all I can say. Anyway, before I kick things off here, we're going to get the disclaimer out of the way. This presentation is presented for informational purposes only. None of the information contained herein constitutes an offer to sell or a solicitation to or an offer to buy any security or investment vehicle, nor does it constitute an investment recommendation, legal, tax, accounting, or investment advice. Don't you love disclosures? You just got to love it, you know? Information here is presented without regard for individual investment preferences or risk parameters and is in general non-tailored, non-specific information. Don't you love that? That's just because that's what I have to say. It's based on information that I believe to be reliable. I will tell you it is, but I have to say that it is believed to be reliable, and investments can and will lose money, and they are not FDIC insured. So, without further ado, we're going to kick this thing off here. I have a really good show. This is my mid-year outlook. This is a good one. This has got some real meat on the bone, as a good friend and CPA of mine used to say, and I'm excited about it. So, I'm going to kick off a little summary of what the first half has shown us, what the second half may show us. I'm going to talk about inflation and the Fed. There's this big transitory narrative. I think it's trending. Transitory, I'm going to call the full one on this. I think it's more trending, but we'll talk about that. We're going to talk about where we are at in the current market cycle. And I'm going to end up in positioning now and really looking forward. Like I said, we got some good stuff. So, to kick it off here, mid-year outlook, kind of synopsis or summary is my favorable first half has really come to fruition. I was really expecting equities to outperform bonds. That was a no-brainer. I really thought that international would begin to come back. That has started to happen. I think we're going to see the economic growth for the second quarter in the U.S. I think we could see a double-digit number. We haven't seen one of those. That's a 10 spot or higher. We have not seen one of those since the 50s. But again, back in the 50s, we were an economic catalyst. We were a manufacturing just juggernaut. We are not that now. So, but I do think we're going to see continued economic prosperity internationally. From a global standpoint, I really look for growth to be at about the 6% mark for the year, which is really strong. Year to date, global stocks are up a little over 8%. S&P is up just a hair over 13, although the last couple of days have been kind of rough. But this strong start doesn't eliminate or alleviate the concerns I have for the second half. I mean, I'm going to now shift gears to concerns. My concerns are really twofold. First, by the time the good news is reported, much of it is already priced in. You say, well, Craig, what do you mean by that? Well, the market is a forward-looking barometer. Okay, it really looks into the future and kind of measures and maps what is anticipated. So a lot of times when they will say, well, it's already baked into the cake, or it's, as I said, much of the movement in the market is already priced in. What that means is the market is expecting certain things to happen, and thus it moves in prior to it happening. It's kind of front running what is going to happen. I have a concern about that, because you wonder, are the numbers going to be as good? And if they're not as good, how does the market interpret that? If they're better, how does the market interpret that? So lots of kind of you sit on your hands and you wait. The second thing is growth may peak in the second quarter. And I really expect that to happen. Now, I look for a peak and it to come down. But still, anytime you peak in growth and the economy begins to shift, that impact has a ripple effect, okay? And that's what I'm really going to be watching and measuring and mapping the data on a daily basis just to see how we need to respond to that, okay? Because the numbers do give you a good idea of where to go and when. And as you know, that's what I'm going to be really tuned in. So, the second half, I'm still very bullish on stocks. I'm overweight stocks, I'm underweight bonds. It's currently favoring cyclical equities in bond sectors. I remain bullish on commodities and kind of bearish on the dollar. So that's kind of where I'm at. What we're going to get into the weeds of that as we get to the end of this episode. But moving on here, inflation. I actually find it pretty incredible how the Fed and Wall Street has just woken up to this idea of inflation. Um, Last month we printed a 5 spot on inflation for the month, which we haven't seen in a very long time. I think it was like 30 years. Don't quote me on that, but it was real close to that. It's been actually since 2008. I think we had a really big move after and during the financial crisis, through into the financial crisis, and we printed a big number. I'm amazed at how this is. The feeling I get is it's snuck up on them. I've been talking for weeks, actually for months. We've been positioned for months for what? A declining dollar and rising inflation. That's how our portfolio has been built. Thus, that's why we are receiving the performance that we have received. So it just surprises me because the numbers have been there. We've seen massive moves in commodities throughout the year, and even going back for the last 12 months. So why this is a shocker is incredible. And I think the Fed, is really, you got to understand, the Fed is data dependent. The last Fed chairman that we had that was not data dependent was Volcker back in the 70s. What was going on in the 70s? For those of you that remember, it was a poop show. We had massively spiking inflation. We had massively spiking interest rates. And Volcker really had to make some very, what I call bold and brave moves that really shifted the whole foundation of the economy and really turned the tide from being super high inflation and interest rates to starting to get things back into more of a normal historical context. Since him, we have not had a Fed chairman that's been bold like that. Every Fed chairman since him has been dependent on data, which is they react. They are not proactive, they are reactive. Reactive means they are lagging indicators. Everything is slow. So I don't look for the Fed to be on the ball. They've missed it thus far. I anticipate them continuing to miss it, to be quite candid with you. While now the Fed has shifted and raised inflationary numbers, my targets from my sources are higher than what the Fed has now, and the Fed is at the top of the curve. So I'm really anticipating, that's why I'm getting back to this argument, whether it's transitory or what I call probably more trend focused. That's really where I am focusing on, because what does transitory mean? It means it is temporary. What they think is we're going to see a spike in inflation in Q2 and it's going to come back down. I think it's going to be stickier than that because we're not going to have a labor force that's at peak employment levels, okay? And I'm going to go out here and I'm going to pull some data on historical trends because there's a lot of talk, or there's probably some not understanding of what the significance of inflation and unemployment have. And basically they've been inversely related if you really go back historically. What it means is anytime we've had low levels of unemployment, usually we have higher inflation. Why? You have lots of people working, which that means you have lots of people spending money, which means we have demand rising, which means we have prices rising. Okay, so that's why they're inversely correlated. Now you get to the reverse of that, or the inverse of that, which means if you have high levels of unemployment, usually that means you have lower inflation. Why? Demand drops. People aren't working. Of course, right now we've got the U.S. government doing well. This is my acting out of our federal government giving money to anybody who doesn't have a damn job and saying, "Oh, don't worry about working." And yeah, I hear this that, oh, that's the Republican. Actually, it's not. It's the truth. I was on a call, Charles Schwab, and they said anywhere from 25 to 50% of the people unemployed right now are not working because they are making more money sitting on the sidelines than working. That is a fact. That's not a Republican narrative. As many of you know, if I have any first time viewers today, this is uncut and unedited. I'm very anti-politics right now. I'm really disenchanted with both our political parties. While I'm a registered Republican, I've thought about pulling that and running free agent because they both piss me off, to be candid with you. So you know what? I call a spade a spade. This is not a Republican narrative, okay? The Democrats will say it's a Republican narrative. That's because that's the spin that they want to create. The Republicans have their spin too, trust me. But here's the deal. Right now, we have high levels of unemployment and we have inflation rising. Okay, those don't go together. So, getting back to what is the Fed worried about? The Fed is concerned that should we continue to see inflation rise and not be at a full labor force employment level, then we have problems potentially. Okay? Because if that happens, the Fed is going to have to do something, which the markets hate when the Fed has to calm the economy down. What do? They raise rates. Going back historically, when the Fed has raised rates on the front end or from a temporary standpoint, the ripple effect on the stock market tends to be negative. So there's some things here. And again, the Fed and the government spinning this transitory narrative. Okay, I've been writing about narratives. I've been talking about narratives for months, people. You have to stinking tune in and not pay attention to the garbage because there is lots of garbage out there right now in the news, from the political front, from the Federal Reserve front, and you have to really dial into the data. You have to focus on the rate of change, on how things are changing. Are they accelerating at a very fast rate? What's going on? These are the things that help me clue into what's really happening. Okay, so right now the Fed has got some challenges in front of them that I tell you what are going to be very, very interesting. Okay, very interesting. So keep your eyes focused on that. Moving on here, where are we in the current market cycle? As you know, full market cycle and Cornerstone Wealth Management advertisement here. My whole focal point as a money manager is managing for a full market cycle. What that means is that as the economy changes in cycles from being, trough, peak, and so on, you have to shift your portfolio based on what's going on. That's what I say investing for a full market cycle means, okay? Right now, all right? I feel that we are getting towards mid-cycle. What that means is that we are starting to get to the top of what? Excess optimism, where all of a sudden, everything is fantastic. You hear the angels singing, and we can do no wrong. I feel that we're approaching that, all right? Early cycle, where do you invest? Small caps, low quality, financials, industrials, materials, non-dividend payers. Where have we been the last 6 to 9 months? That's exactly where we've been. Now you transition to where you get to peak cycle and it starts to drop off. All of a sudden you shift. You focus on more large cap, high quality, defensive sectors, utilities, staples, healthcare, dividend payers. You see the shift? Here's the kicker. When do you do it? You don't want to be too early because you miss out on the last part of the economic expansion. But you don't want to be too late and sit around, which it's not being too late, it's doing nothing. It's holding your allocation and riding it out. It's like being on in a boat in the ocean and you turn your motor off. You know what? You're going to go wherever the waves take you. I don't like that. I like going where I want to go. So there's going to be a point where this shift is going to take place or begin to take place. Right now, I'm watching it very, closely. Okay? You don't jump the gun, you don't guess, you don't make emotional decisions. You hear me talk about that a lot. What are we going to do? We're going to focus on the data that comes in. We're going to continue to measure and map. We're going to continue to execute our mathematical process of measuring how things are moving and changing from point to point, because it is not a straight line. It jumps around, it moves all over, and that's where in lies what's going on. Okay, new positioning here as we close out from a global standpoint. Right now we're continuing to be overweight equities. Okay, I own very few bonds. The bonds I own are on the credit side, which means corporate debt, mainly high yield, although I do own some high quality corporates. And then I'm on the tip side, Treasury inflation protection notes. It's a government treasury tied to inflation. Why? What is inflation doing? Going up. That's why we own tips. Okay. What I'm excited about, Europe. You think Europe's a mess. Europe has gone through multiple lockdowns, and that is fact. But what is the market again? It's a forward measurement tool. What is starting to happen in Europe? Manufacturing's been pretty strong already, and they've been in lockdown. So as they roll out of COVID, you're seeing vaccination rollouts in Europe and in Asia and other developing countries. It's improving. I really think there's some positive numbers coming in Europe. They're lagging the U.S. There's going to be a shift eventually where we're going to be lower weight U.S. and probably higher weighted international. Oh my gosh, I know I'm tipping my hands here. U.S. stock market, obviously, still there. U.S. is still the place to be. The U.S. is leading the world right now, and thus that's where we're going to stay, and we're going to maintain there until it begins to change. Okay. If you look at from a global economic standpoint, I'm really kind of my sources are forecasting a 6+% growth from an economic standpoint globally. I think that's probably right in there. I really anticipate the continued recovery and the reopening from COVID to really spur a lot of international expansion. As that happens, we will continue to see exposure there and see exposure growing. On the fixed income side, you know what? The Fed came out and talked about tapering, which means that they've been buying government debt. Okay, they're actually the largest owner of U.S. debt. It's not China. Number one is actually Japan. Number two is China. That's another misnomer that's out there. Well, China owns all our debt and they're going to screw us. No, actually Japan does, and actually we own as much, if not more. So the government is going to start selling $12 billion worth a month starting in January for 10 months. Do the math. That's 1.2 trillion, assuming they execute all of it. If they are selling, that is going to drive prices down and interest rates up. So thus, I am still bearish dollar, and I think interest rates are going to rise. We've had this little freak out here since the Fed decided that we're in an inflationary world here the last week to 10 days. It's temporary. Don't buy into it. Okay? Don't think the world is ending and, oh my gosh, the dollar's strengthening. No, it's temporary. It is what I call a temporary, episodic rise in volatility, of which we're seeing the rise in the dollar and we're seeing interest rates drop. So that's going to get back to normal here soon, and I really anticipate that. Man, I get tired. I almost need a drink here. What am I in? I'm 18 and a half minutes in already. My gosh. So in closing, here's where we're at, okay? Lots of exciting stuff coming down the pipe. Second quarter is going to be good. Earnings for second quarter are going to be fantastic. How fantastic? Do they overshoot? Do they undershoot? How does the market handle it? I think what we're experiencing right now in the market is going to be a temporary episodic volatility spike. That's why you're seeing the markets do what they do. It's all in response to what the Fed said. New increase in inflationary numbers, talking about tapering. What's the natural response? People freak out, investors freak out, dollars up, interest rates down. That's what should happen. It's temporary, okay? The kicker is we got to keep our eye on the ball. We got to keep doing what we're doing. I come in every day and you grind it every day. I do the same process every day because it helps lead me point to point, when to act and how to act and what to act. So, thanks for joining me today. I hope this really helps for my mid-year outlook. Wall Street X's and O's for the week ending June 18th. It is great to see you guys. Have a fantastic weekend wherever you may be. Thanks for joining me. And this is Craig Modelmog, and I am out.